Important note, this video is not financial advice. Always do your own research before making any investment decision. Past performance does not guarantee future results. Here's your market briefing from Rumour with AI. Physical Bitcoin is facing a regulatory reckoning that threatens to redefine digital asset ownership. The market for tangible crypto artifacts, ranging from vintage Casascius coins to modern open dimes, is undergoing a severe valuation correction. Regulators have intensified scrutiny on these physical representations of decentralized currency, citing money laundering risks and unregistered securities violations. This pressure has frozen secondary market liquidity, forcing collectors to hold assets at significant discounts to their face value. The era of easy physical crypto arbitrage appears to be over, signaling a broader institutional shift toward regulated, digital-only custody solutions. Meanwhile, the political economy of artificial intelligence is heating up. Senator Bernie Sanders has launched a direct challenge to Elon Musk, questioning the viability of Musk's universal high-income proposal. Sanders argues that Musk's refusal to support a 5% wealth tax on his $817 billion fortune undermines the social contract required to fund AI-driven job displacement programs. This political friction highlights the growing tension between tech oligarchs and traditional fiscal policy, potentially impacting future corporate tax structures for major AI developers. On the macro front, geopolitical risks are spiking as US-Iran peace talks stall. Negotiators are struggling over a one-page memo intended to end hostilities, with uranium enrichment timelines remaining the primary sticking point. Complicating matters, the release of $450 million in frozen Iranian crypto assets remains unresolved, creating uncertainty in energy markets. Investors are closely monitoring these developments, as any breakdown in talks could trigger immediate volatility in oil prices and regional equities. In related news, Barclays has issued a provocative forecast regarding the intersection of robotics and monetary policy. The bank projects a $200 billion humanoid robot market by 2035, arguing that widespread automation will structurally boost real interest rates and equity returns. Barclays suggests that despite geopolitical headwinds, the productivity gains from humanoid labor will outpace inflationary pressures, making equities the preferred asset class for long-term growth. However, the European monetary landscape remains constrained. The European Central Bank has rejected a Bruegel proposal for euro stablecoin liquidity support. ECB officials cite unacceptable financial stability risks, noting that dollar-denominated tokens continue to dominate the $300 billion stablecoin market. This rejection underscores the ECB's reluctance to cede monetary control to private digital assets, leaving European fintech firms without a central bank backstop for stablecoin operations. Looking ahead to today's release, the economic calendar is notably quiet. There are no major high-impact data points scheduled for the next 36 hours. Markets will likely trade on geopolitical headlines and corporate earnings guidance rather than macroeconomic surprises. Traders should remain cautious, as the absence of data releases often leads to thinner liquidity and wider spreads, particularly in the crypto and European equity sectors. That's your market briefing. Follow Rumour with AI for daily market intelligence.